Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. Recently, I've been relentlessly actually asked to cover the sell-off in Chinese stocks that has recently occurred. And, at first I was hesitant because, to be quite honest about it, I'm not a real big fan of the investing in the Chinese VIEs or ADRs. For reasons I'll get into here during the video. But you do have to give the devil its due, so to speak. The Chinese market's a huge market, and there are some really tremendous growth stories to be found there. And, the old adage in Wall Street is, you take greater risk to get greater reward. And, the risk-reward relationship or ratio on these Chinese stocks actually looks compelling. But there's another reason I decided to go ahead and give in and cover these stocks, because I really do believe that regardless of the politics and everything else associated, there really are a lot of lessons on valuation that contained in there. And that's something, as those of you who have followed my work regularly know, that I'm very passionate about valuation. So let's kind of get into the recent Chinese stock sell-off, and let's look at some of the more prominent Chinese stocks, including the ones that really instigated the sell-off in the first place. So number one is the stocks that really got hit the hardest were TAL Education and New Oriental Education and Technology, where they dropped 70% and 54% respectively. And I'll show you that in more detail in a moment. Now, educational training institutions are banned from raising money through stock listings, while foreign capital cannot invest, according to a copy of a new policy document seen by CNBC. The reports came as Chinese authorities stepped up restrictions in recent months on the private education industry and amid increased scrutiny on domestic companies listing overseas in the U.S. So there's a real political issue involved here that I think really needs to be, considered. Now, another article in Flowbank that I came across, which was written in July of 2021, July 30th of 2021, says the story behind the Chinese stock sell-off and why it might not be over. And it goes on to say Chinese stocks are experiencing a sell-off as concerns around regulatory crackdowns continue. To understand what caused investors to doubt their tech holdings, let's take a look at the Chinese tech industry itinerary that led the country to a market crash. And the article goes on, and I'll put links to both of these articles below in the things so you can read these for yourself. But the point is, there actually were reasons. So let's start by looking at the two educational stocks, because as I mentioned, I think there's a great lesson in valuation. Number one, these stocks had some pretty good earnings growth. TAL Education had some pretty good earnings growth up through, and let me go ahead and scroll out here so you can see what I'm talking about, had some really incredible earnings growth up through 2018. And the stock price, of course, as common sense would suggest, tracked that growth, that tremendous operating earnings growth. Now, in 2018 and then in 2019, at the beginning of 2019, this has a February fiscal year end, by the way, is why you're seeing some weirdness looking here in the graph. The company's earnings grew at 57 and then 79% respectively. And of course, that created a huge surge in stock prices. And all of this is about the metaphor that I don't get ever tired of sharing with you. Anyone who's followed my work here knows that I'm often quoting Ben Graham's famous metaphor: in the short run, the market's a voting machine, and in the long run, it's a weighing machine. That's critically important to value investing because it really highlights the distinction between market value and intrinsic value. Market value is the voting machine, when people vote their dollars and get excited and they buy shares, and it's the old rule of supply and demand. Intrinsic value is the weighing machine, which is what the fundamentals, the actual weight of the business actually, represents to the shareholder. And as you can see, TAL Education here, TAL Education's stock price rationally followed earnings, and when it did get disconnected temporarily, it came back. And then, of course, what happened was, then we had some really bad earnings results in 2020 and actually through February of 2021. But the stock still held up pretty well. In February of 2021, we had this nice drop. But recently, we saw this huge drop, that I mentioned in the articles previously, which actually I measured at about almost 90% from, peak to trough. And I'm not sure exactly on this graph where that happened. But I do want to make another real strong point here. This to me was logical because there were no fundamentals supporting it. Now, another way I like to look at companies like this, I also like to look at them through operating cash flow, especially growth stocks, because growth stocks tend to use a lot of their earnings to grow. And so from a standpoint of operating cash flow, the picture actually is a little more rational on Untitled Education. The stock price followed the operating cash flow growth. When the cash flows faltered, the stock price faltered. Then when the cash flows began recovering again, the stock price recovered. But once again, it got significantly overvalued. But nevertheless, this is a political risk being associated here because analysts are still expecting cash flow growth. But the question is the politics, is the Chinese government going to allow these businesses to continue to grow and prosper? So that was Untitled Education. The next education was New Oriental Education and Technologies. And this was another one that had this huge collapse. But once again, I want you to see that this was a valuation issue in the first place. The stock was trading at extremely high valuations. If I go ahead and run that through operating cash flow, forget about the fact these are a Chinese company. Look at it just from a standpoint of fundamentals. We saw this stock generate, really strong growth based on the fact that its cash flow growth was very, very consistent and very strong, notwithstanding what happened in, 2020. And this has a May fiscal year, which is really kind of COVID related, obviously, in this case. But nevertheless, we had this huge sell-off in the stock. And of course, this spooked the entire Chinese market, but it was primarily, as I pointed out in the beginning of this video, focused on the fact that they were cracking down on the educational stocks, the Chinese government. But I do want to go in and look at some of the other more popular. Here's IQ, which is a very interesting company. It's movies and entertainment. If you're not familiar with the company, here's their website. They're kind of like, I guess, a Netflix, if you will, in China. They, produce a lot of movies, both on subscription and free, et cetera. And I don't know a whole lot about this, but it came out with an IPO and then it had this huge rally and then the stock price collapsed. And this is EBITDA. It's been trading, above and below its EBITDA kind of consistently. But now since this sell-off occurred, the stock was undervalued, but now it's got hit even harder. But based on EBITDA and EBITDA expectations, which not yet have changed. Now, these might change in the future based on, as this story begins to unfold. But we're already starting to see some rallies in these stocks. So let's look at see what's happening to this stock today. And you can see it's up 3% today. So a lot of the stocks that aren't directly related to the educational issue, which is what instigated this, are already starting to rally. I'm going to kind of go up the food chain here of Chinese companies in Tsai. This is Pinduoduo, I think it's the way it's pronounced. At least I kind of checked it out on a video that they produced. And this is another one that has really strong operating cash flow growth. And prior to the sell-off, just recently prior to the sell-off, the stock had become extremely overvalued. Now, this has a December fiscal year by the end of 2020. And then, throughout March of 2020, it kind of started to revert to the intrinsic value a little bit. And then, of course, when this, announcement of the government cracking down on the educational companies in the Chinese market, especially those listed on foreign exchanges, then we saw this sell-off. This would actually look like a reasonably attractive company today based on, its priced operating cash flow, okay, and the fact that it still is forecast to grow. But now I do want you to notice the forecast growth rate, although double-digit, wouldn't actually support, because here I would adjust the valuation down to a 17 PE, where historically this company has grown at almost 30%, 29%. So I'm using a 29 PE here. But when I look at it from a forecasting point of view, the expectations are that that growth is going to slow down, almost be cut in half. And that would indicate a price, somewhere down here in this, $60 range rather than the 91 it trades at. So even though, we've had this nice correction, this may be a bargain in the making. But again, I do want to illustrate and reiterate how valuation plays such an important role in what happens to all these companies. Now, this is a very interesting company. You can go to their website and, they tell a story. They have this pin technology where they allow the Chinese market, I guess, primarily to work in groups and get better buys on products. So it's kind of maybe a Amazon that also gives you the opportunity to generate some purchasing power through bringing some friends in. It's kind of an interesting company. Does have, a good history of growth. It's a $114 billion company and only has 15% debt, which is kind of attractive. So, just don't throw the baby out with the bathwater. If you are willing to take the risk of investing in Chinese companies, you might want to look at some of these as I go up the food chain. As I mentioned, based on the forecast, I do consider this one still a little bit expensive. Now, Baidu is one of the more, famous. It's kind of like, I guess you would call it the Google, if you will, of China. And here we see a very clear relationship between earnings and growth. The company's average growth has been it's been over 25%, and it's grown really well. And again, I want to look at this from a standpoint of operating cash flow, because I think that's also an important way to look at these growthier stocks. And it actually trades more in line with its operating cash flow than we saw with earnings once, the cash flow started to, what I would call, become more rational or reasonable at about a 15 or 16% growth. From a forecasting point of view, growth is expected to stay about in that range. That would make Baidu a real strong bargain now, but keep in mind there could be some, tumultuous times ahead. But anyway, this stock, for a growth stock perspective, looks very reasonably priced today. Then JD.com, which is one of the larger ones here. JD.com is internet and direct marketing to retail. This company's had tremendous growth, but if you really look closely at this graph, notice that the stock really didn't do much for 4 or 5 years when they weren't making any money. But then starting in 2018, they had this tremendous growth year, and then they had another good growth year, and then 50%. And then they had a down year, I guess coming out of COVID here. Now they're expected to grow very strongly again. Forecast growth is about 15%, but this stock is extremely expensive looking based on that if you're really a fundamental investor, as I am, because let me show you something. As I try to get rid of some of these aberrant numbers here and start, calling out some of these crazy years, here I've still got 200% growth. But keep in mind now, the year prior to this, we had this 4,545% growth, which we didn't even calculate. So we just drew a 15 PE here. But this was an extremely high rate of growth. The fast graph doesn't calculate, it doesn't make any sense. But here we still have 55% growth, and we have 60% and 40% growth expected for the next 2 years. The problem is beyond that, because once you get past that, then the growth begins to slow down dramatically based on consensus estimates, and the stock could start to look real expensive, and long-term growth doesn't look real good. Now, I don't know if any of these numbers are real or not. This is something, if you're interested in this stock, you'd want to research yourself, but frankly, I personally wouldn't be interested. Then, of course, there's Alibaba, which is probably one of the more famous ones. Now, this stock has traded in alignment with its operating results historically very beautifully. It has periods where it gets slightly overvalued and it came into fair value. There were times when you could buy it at a bargain, but earnings growth has been over 35% historically. It's forecast to grow at about 15%, which again makes it look expensive to me over the near term, but if longer term, it's expected to grow at over 20%. So in this case, I would put the two estimates together, and Alibaba could be a very, very interesting stock, but notwithstanding the fact that it's over a $500 billion market cap today. But it is a very fast-growing company, and it does, analysts are expecting it to continue to grow. This particular sell-off was one of just sympathy with the rest of the market. But I think, this could be a bargain in the making here. This could be one of those stocks. This company's A+ rated. It's 14% long-term debt to capital. Now, keep in mind, this is an ADR. It's not a direct ownership of the company, so you'd have to trust that relationship and those covenants and contracts would continue to exist. But again, no risk, no reward. This could be a case where you might want to take that into consideration. And then last I'm going to look at is the granddaddy of all, which is Tencent, which is an A+ rated company. It's had very consistent earnings growth, and the stock price has followed the fundamentals as you would in any market, U.S. market or China market. The overvaluation always reverted to the intrinsic value. You didn't get a chance to buy this stock at an undervalued level very much, or at least not much of an undervaluation level, but you've had really tremendous performance results. I haven't talked about performance much. I'm going to make the exception here with this company because I want you to understand the risk-reward relationship that I'm talking about. Had you invested in this stock in November of 2008, the price split adjusted would have only been $1.37. As of Friday's close, it closed at $61.64. It did pay a dividend, and the dividend has actually grown, very fast at a high rate, almost, over 30% average, 29.7 compound average growth rate. you would have got more income than the S&P, and it buried the S&P in terms of performance. So, here's a classic example of a stock who rewarded shareholders in almost direct relationship to the growth of the business. And that's the point I want to get across. Now, once again, growth going forward here is expected to slow down, but it still is expected to grow pretty fast. So, this drop in the value of the stock may have created an opportunity where you could start considering watching this stock and looking to buy it. But I do want to be clear. I'm always making the distinction between his history, which is real, it happened, and the company's stock price reacted to the historical results. In my view, there's no reason why it's not going to react to the future results, but it's going to adjust to what level of growth it is. Now, this may not happen right away. It may take months or even a year or more for this to happen. But again, I don't consider the stock really cheap now. But the sell-off is not just a universal generic point. There were reasons that some of these companies sold off that were different than what some of the other companies sold off. There was a catalyst, which is the Chinese government getting stricter and potentially, causing some concern about whether or not you'll be able to continue to, have your investment, whether the liquidity will be there, whether they'll be forced to be delisted, and all kinds of what I would call political risk here. But the reality of it is the operating results of these businesses has proven that operating results matter a lot. The real key is, what are they going to look like in the future? So I personally am not, a big fan of investing in these stocks because of the uncertainty, but that's me. That doesn't mean you shouldn't. But if you do, I do believe it's very important that you should pay attention to the fundamentals, just like you do on any other stock you would invest in any other market, US or European or whatever, because in the long run, earnings drive market price, and that's really, the bottom line. Now, one last little bonus feature I'm going to show you here is I'm going to turn to the new version of Fastgraphs, which is going to be adding price to sales. And I'm looking at these companies from a point of view of revenues or sales. The picture is quite different, but you have to be able to trust that, because I'm not so sure how reliable it is to just base this on sales, but these companies are all looking pretty good from a standpoint of price to sales. They all look very inexpensive from a revenue basis. So that might be another factor that you might want to take into consideration. These companies are growing. They may or may not bring that growth to the bottom line, which ultimately is going to have an impact, because you're always going to get the earnings being reported, but you also get revenues being reported as well. Baidu looks especially cheap relative to sales, but as I shorten the time frame, you see the sales growth is materially different than it was when I run this, 40% growth, and I'm using, a much higher price to sales. But the reality of it is, as I shorten the time frame, I get a different growth rate in sales, and the stock starts to look interesting, at least from a standpoint of valuation. And even Tencent looks reasonably priced relative to its sales. So this is another way to look at it, and I bring this up because valuation is, a puzzle, and you want to look at valuation from a lot of other aspects, but at the end of the day, as an investor, you ultimately have to make your own judgments about what you're looking at and what amount of risk you're willing to take and what your potential rewards are. And that's one of the lessons I really try to focus on. Always run the numbers out to the logical conclusion and weigh all the risks. So, don't just look at one metric. Don't just look at PEs. People tell me all the time, why are PEs so sacred? They're not. The reason, I've built all of these other metrics into the Fastgraph tool, including things like, price to EBITDA and so on, when it's appropriate, is because I want to look at these companies in as many different aspects as I can to try to ascertain what kind of value I have. And with very fast-growing companies, earnings yield becomes less important than it does on typical, average or normal growth companies, because it's the future earnings or the forward earnings that matter the most. And that's the same with sales and revenues. But at the bottom line, you got to dig into these companies, go in their financials, look at their margin potential. Are they going to be able to maintain those margins? What kind of competition's coming in? There never is a shortcut for comprehensive research and due diligence, but it always got to start with valuation, at least in my opinion. Anyway, this is what my take on the current state of the Chinese stocks listed on the New York Stock Exchange, some of the more prominent ones at least. I hope you enjoyed it. If you did, ring my bell, give me a like, subscribe to the channel if you haven't, because I'm looking forward to a lot of exciting things happening on this channel in the future. We're going to be launching our academy, our Fast Graphs Value You Academy pretty soon. We're going to get into how to read financial statements, much more depth, how to value businesses. And we just got a lot of exciting things coming down the channel. So you might want to subscribe now so that you get notifications when those happen. And you also might want to try a subscription to our Fast Graphs research tool. I wouldn't even consider investing without it. So anyway, thanks for watching. Look forward to talking to you again real soon.